There we go. All right. Good morning, everybody. It's Hammer. Today is Tuesday, February 13th, 2024. I, of course, am with Originator Success. Here's a daily rate lock conversation, the only place on the web where you guys get to be a part of the conversation. I don't like this hat. I think the brim is too small. It looks kind of funky to me. Looks, anyway. I'll let y'all join in. I'm done. Remember, you can join me live each and every day, 9:30 a.m. Eastern time, as I do the show live for you each and every day. If you're here live, say good morning, like Kyle Mazekas and Bobby Searson, Mallory Fodiatis and Mr. Ron Siegel, Mike Tebow, Simon Glenn, Megan Lindberg. Good morning, all. If you're on the replay, don't forget, give us a hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, tag an hello friend, share this post in a group. Remember, you can go ahead and sign up for our email lock advice. It goes to your inbox each and every weekday morning, www.ratelockadvice.com, or you can use this cool QR code. If you're watching on your computer, you can take your phone and snap that thing up. You can also sign up for our text alerts, www.ratetextalerts.com. Last but not least, don't forget to check us out at originatorssuccess.com. What's up, Candido Diaz? Robert Bashirs, good morning, sir. And do that. If you'd like a reminder, by the way, that I'm going live in the morning, go ahead and sign up here at hmmr.io/live-reminder, or use the QR code. It's a lot shorter and a lot easier. All right, my friends, all that said, we've already said hi to all of our live folks here, and I appreciate you. Let's go ahead and talk about what we got going on this morning. I got to fix this one. Rate sheets today gonna be ugly. All right, there we go. I started one low. All right, rate sheets today are going to be ugly. CPI inflation data came in this morning worse than expected. I tried warning you yesterday. I don't know whether it came in this way because of the seasonal adjustment factors that we've talked about, or because the data is actually worse. But either way, as I said yesterday, we just didn't know how it was going to come out. And we didn't necessarily know how the markets would react, but none of it was good. Let me go ahead and show you what's going on with the charts and the graphs and the funky stuff here. So as we take a look here, mortgage-backed securities. Hey, get back on that screen. Mortgage-backed securities, the 5.5 coupon, currently down 45 basis points. It's a little bit less so if you look at the 6.0 coupon. That one's down about 30 basis points. It doesn't really matter which one we follow, because we're probably going to end up pushing back towards the 6. Right now, according to Mortgage News Daily and Matt Graham, they've got a little star next to the 5.5 because that means that one is the primary coupon. Generally, it's getting more trading volume. Some interesting things that you could see here as I zoom in on this. You can see that, check out this candlestick right here. Do you see this candlestick right here where my mouse is jiggling? We came down and the tail came down to the 200-day moving average and then bounced back higher. That's an interesting thing to pay attention to and be watching. 10-year treasury yield all the way back up, 4.27. Remember that we were down 3.798. We were at 3.80 basically. Over here, 3.88, and we are all the way back up. Now, I'm going to take a quick screenshot of this and show you a couple of lines on the 10-year treasury yield because they make a difference. So let me click this. Come on, bring up my little, where is that window? There it is. Okay. All right, so let me take a quick screenshot of this. Boom. Okay, so if we draw a line, we were at 4.18, which was right there. And this is actually down a little like that. Okay, so you can see 4.18, we hit it right here. 4.18, we were hitting it here, we hit it here, and then boom. See this? It pushed way above that. We're now at 4.27. This is a big deal. This is going to open up the door for a whole new technical range up to this green line, which is the 100-day moving average, I'm pretty sure. Let me double check that. Let's see. This should be, yep, the 100-day moving average. All right. And that's at 4.34. So we've now got a whole new level. And then this 4.18, instead of being a support level, because remember, we want to see the 10-year treasury yield go down, not up. So this is support when it hits this. We want to see it bounce off and go down. So now, instead of being a support level, now that we've broken above this, it's going to be a resistance level, and we're going to have to see it pushed through again and drop back down. And quite frankly, it's just not likely to happen. All right. Basically, reprice risk on the day today. Bonds have held steady after that CPI data came out. Let's take a look at that together. I'll put that on the screen again. So taking a look here, let me get rid of this. You could see that it went straight down here. Come on. We went straight down and it's kind of recovered a little bit. Let's go ahead and do a 2-day chart. All right. So you could see straight down after that data came out. It's recovered a little bit. And now it's just a hair weaker here, but this is probably where it's going to hold. Now, what can happen though? We're already down about 50 basis points on the 5.5. If we start to get more selling, it's going to jump down again. It's going to drop again. Lenders are going to be in a position to reprice worse very quickly today based on all of this negativity. So my advice on this, yesterday I talked about locking anything that was closing near term, risk averse, that we didn't know what was going to happen with this data. We just didn't know which direction it was going to go. There was a lot of forecasts that it was going to go below 3% for the first time since I think it was March of 2021. And it didn't, right? So what was the actual data? Let me show you that real quick and we'll have some chatting about this and then we'll go back to the screens here. So when we look at the actual CPI data, how did it really come out here? Let me find the chart. Look at this. Bond yields surge after the CPI. Boing, like a rocket, straight up. Is this what I would have thought that this had the little chart saying where everything was. Hold on a minute. I guess not. Which one of these had that? Let's try this one. There it is. Okay. So here's your actual numbers. Right here is the actual, and over here is the estimate, what it was thought that it was going to be. So the CPI month over month, this is what we call the headline number. Okay. The headline number came in plus 0.3% when it was estimated to come in at plus 0.2%. It's really not a huge difference, right? I mean, you're talking 0.1%, but it makes a difference. Core CPI month over month, the core takes out energy and food prices, which are considered to be more volatile. That was plus 0.4%, and it was estimated to be 0.3%. Now, if we had come into the good on these, well, we'd be sitting here cheering. The year-over-year numbers, though, were much higher. It was 3.1% versus the 2.9% forecast, and that's for the headline. The core was 3.9 versus 3.7. So everything came in higher. Now, it could be argued how much of this had to do with those new seasonal adjustment factors that I told you were going to be rolling in. Well, I don't know. I haven't seen anybody that was able to really kind of do a comparison, and nobody knows exactly how those factors are done anyway. So, but this is higher. Why is this such a big deal? Because the Fed has raised rates 11 times since March of 2021 or 2022. And in those 11 times, they stopped July of 2023. So we haven't raised rates since July of 2023. However, we also want to see rates go down. The Fed is likely to cut rates because it's like applying pressure on the brake pedal. Yes, you push until the car slows down. But if you don't let go again, well, the car will come to a complete stop. And that's our economy in this analogy. The car is the economy. The Fed does not want the economy to come to a stop. They don't want to drive us into a recession. So they're going to need rates to a neutral position. The problem is en masse messaging over and over and over that it's not yet, that they're not ready to do it, that it's not going to be in March. And markets were originally, when we look at Fed futures, remember, there was at one time a 75% expectation that we would have a rate cut by March. That is now down to less than 5%. It's totally almost non-existent that the Fed would cut rates in March. It's not even on the table anymore. Basically, it's dead, right? Well, then we move to May. Now, May, just yesterday, there was a 60% chance that we'd see a rate cut. Well, now there's a 60% chance that rates will stay the same. That means it's only 40% chance that we see a rate cut. That is the jump that we saw this morning as we saw market sentiment shift. Okay. Markets are waking up to the reality that the Fed doesn't support a rate cut and that the Fed is not going to have their arm twisted by all this data and be forced into it. It means mortgage rates are very likely to hold in the range that we're seeing now. Going to be in the low sevens on conventional conforming, high sixes for Govy stuff. It's not likely that we see rates that are going to drop down from here. Ron's pointing out the Fibonacci resistance level at 4.29 for the 10-year Treasury yield. I don't put a lot of stock in that it's going to hold. I think it's going to break, Ron. I think we're going to see it push all the way up. I think it'll move higher. Maybe not today or tomorrow, but I do think it'll move higher. I think we're going to see that sentiment move in that direction. Mike Tebow asked, hold on, getting here. If mortgages are either 15 years or 30 years in length, what does current information affect long-term rates so much? Well, it has to do with the immediacy of the yields, Mike. And it's not that the bond itself is 30 years, but how much money am I making on it today and tomorrow, next week, and next year, right? So when it comes to yields, I'm not looking at that the instrument is 30 years. What that means is I'm tying my money up for 30 years, but it doesn't mean that my yield over the next 6 months or year is what I'm really worried about. You know, where is that going to take me? How is that going to be an investment? Why am I going to put money into it? So 10-year Treasury yields, 10-year Treasury is the most secure investment because it's backed by the US government. So the yield, this is like getting guaranteed return on your money. Let's call it 4.25. We'll just round it right at this moment, right? So if you're getting $4.25, that's your savings account. It's guaranteed. It's insured, right? But you may be able to put money into stocks and get 9, 10, 12%. But that money is not guaranteed and you are not guaranteed that return. So that's why when you're looking at a safe return and yields, that's why all of this matters. It's what am I getting today compared to what I could be doing in the open market with other investment sources, et cetera, et cetera. How is my money making money? When we look at the bond prices right now, you're getting $100 worth of 5.5 coupon at 98.92. So you're getting a discount. What that does is it increases the yield. So instead of getting 5.5% interest, I'm actually going to get a little bit better than that because I'm paying less. So my effective yield is actually a little bit higher than 5.5. If I want something that is at 6%, then I'm paying $100.42 for $100 worth of that coupon. That means I'm paying a premium instead of a discount. So paying that premium, I'm getting a better yield, guaranteed yield. And again, how does this compare to other investment instruments in the near term? That's why all of this matters to markets and traders and balancing portfolios and all that stuff. Ron's also answering. He said the markets will look at how long do people actually hold the loan as well as the loan duration. If the average loan is historically held for 5.2, the piece of the insight to the effect of the 10-year discount rate on the 15 or 30. So yeah, that's why you see that the 10-year Treasury is more is a better comparison than a 30-year bond. That would be, even though mortgages are for 30 years, and it's because the effective term of this bond is about 10 years. And then they find that what happens is they've lost enough of the mortgages that are in it that they're not getting a return on investment anymore. And then they redo it and blah, blah, blah. So anyway, that's kind of some great answers to all those things there. Looking to see if we've got anything else that needs to be talked about. So basically, again, I'll throw it up on the screen for you. This morning's data came in showing stronger inflation than what was expected. Whether that was due to the seasonal adjustments or not, we don't know. But markets don't like it either way. Basically, the lock advice is to cautiously float to start the day just to see if we're getting any kind of improvement in these numbers. Like right now, we're down 39 basis points. We've seen a little bit of improvement here. Let me get rid of this for a second and show you. There we go. So we've seen a little bit of an improvement here. We want to see if this continues. and that's why we're just cautiously floating for the moment to see if we continue to see any more improvement on that. But the outlook, markets are waking up to the reality that the data does not support a Fed rate cut in March or May. And we're back to looking at maybe June for the first rate cut. And you can see that right here. Markets are back to pricing that in. Still a 25% probability that rates will be unchanged in June. And when you compare that to where we have been, I mean, just a month ago, there was like 3% chance that rates would be unchanged. A week ago, there was, it's not even showing a week, but actually that is a week ago. It was 3%. A month ago, it didn't exist at all. That's why you're not seeing it there. A month ago, it was almost like totally expected to be down in the fours. But a week ago, there was only 3% chance. A month ago, there was zero. A day ago, it was 8%. Now look at it. It's all the way up to 25%. That's a big change. It shows that markets are adjusting to the idea that the Fed does not need to cut rates, that inflation is not going down fast enough, that the labor market is still performing strong enough, and that the economic data supports that the economy is still chugging along well. So all of this is not good for lower mortgage rates, my friends. It looks like that we're going to kind of stay where we're at. Now, the good news is this is good for EPOs and things like that for sure, because we've seen rates that are in here. I told you yesterday that rates could go up about 0.25% today. I think you'll see 7.25. We'll be up from, we were just a hair below 7 yesterday. You'll be up around 7.25 today before the loan level price adjustments. Robert said, remind me, where were we at the 6 yesterday? And now were we at the 6 yesterday? Now the 5.5. No, again, it doesn't matter which of these you look at, guys. I'm watching the 5.5. The reason that we're watching the 5.5 is trading volume. If there's more trading volume, it's a little less erratic in the actual trades. When you look at these bouncing small on the graph, you see these little small jumps up and down. That's the actual, trades, if you will. When you look at the 5.5 versus the 6.0, there's really not much of a difference there. We're down 27 basis points on the 6.0, which looks a lot better compared to 39, but it's really not. It's a minor difference. So it doesn't matter which of these that we're watching. And generally, if we see rates that are up around 7.25, we would be looking at the 6. That's generally the one. The 5.5, according to Matt Graham and MBS Live, gets more trading volume, so it's just a little less erratic. But we could go back to looking at the 6 at this point, and we're still down on the day, so it doesn't really matter which of those that we look at. So, all right, my friends. Well, it's 20 minutes in. I think we've done a pretty good job explaining all this, talking about all of it again. My lock advice, cautiously float just to see where the day goes, but don't expect to see rates drop from here much. Our best shot now is to maybe see a little bit the PCE data later this month instead of the CPI consumer price index. We're going to see the PCE personal consumption expenditures index later this month. And that is the Fed's favorite gauge of inflation, but really it's going to be the labor market data on March 8th to get there. So Christopher Griffith, I only tune into these to hear when rates are dropping. You're losing me. I'm with you, brother. I get it. It's not fun when rates are going up. So the good news is we're still not in danger of going where we were back in October. That was when we saw our worst levels. We saw, rates hitting 8%, above 8%. We're not in danger of seeing that. We're not moving into that realm. We're not yet in danger of seeing the Fed talk about rate hikes. If we were to see a few inflation reports in a row that showed inflation was creeping in the wrong direction, that would be very scary, but it's most likely just one report. So, all right, my friends, I'm wrapping it up. Thank you all for joining me. I'll see you guys tomorrow, and try to make the best out of today is all I can leave you with. Bye-bye.